testimony for the importance of this network. For those of you who do not remember what we said when we announced Mars more than a year ago, I would like to first recall in this brief opening its main purpose and lines of work, and then I'll try to summarize the amount of work that has been done halfway through the envisaged 2 years. The Vice President, Vitor Constancio, will speak later in the morning, and he will discuss the substance of the preliminary results that have been found so far. Now, the General Council of the European System of Central Banks established Mars in spring 2010 because one main lesson of the financial crisis was that the macroprudential wing of financial supervision and regulation needed to be strengthened, and the scientific foundations and analytical tools for this relatively new policy area were not developed as well as would be desirable. Accordingly, the objective of Mars is to develop core conceptual frameworks, models, and tools to improve macroprudential supervision in the European Union. The European Systemic Risk Board, which started its work in January this work with the explicit mandate of preventing systemic risk, would greatly benefit from Mars results. And I have to say that what I observe is that we have the same effort, intellectual effort as well as operational effort, all over the world, at least in the advanced economy and on both sides of the Atlantic. The work of Mars was divided in 3 work streams, which you also see reflected in the conference program today and tomorrow. Work stream 1 deals with relatively fundamental research on macro-financial models linking financial stability and the performance of the economy. Session 1 on financial instability and the macroeconomy. Session 2 on leverage cycles and macro-financial linkages. And Session 3 on macroprudential policy feature papers that address work stream 1 research questions. Then we have work stream 2, which covers more operational analytical work on early warning systems and systemic risk indicators, 2 topics that are addressed in Session 5 and 6 tomorrow. And work stream 3 on assessing contagion risks is the subject of Session 4 this afternoon. Given the many open questions in the analytical underpinnings for macroprudential policies, Mars is a relatively large undertaking. All 27 national central banks of the European Union and the ECB are engaged in it. Overall, we counted 200 economists contributing to more than 120 projects, a few larger and many smaller ones. About 50 of the individual projects are at an advanced stage in terms of a paper being available or an analytical tool having been provided. But many more projects have made significant progress during the first year. At the present stage, however, a lot of results are still preliminary and need to be subjected to further robustness checks. But some of the analytical tools covered in Workstream 2 are already in use in some central banks. Mars having been planned for, as I said, the 2-year period, most of the results are being expected next year, of course. And we are envisaging to inform interest authorities, academic researchers, and the general public about them. Of the many Mars projects, only a small selection could be included in the program of this conference. The other papers and presentations in the program are from researchers who happen to work outside of the ESCB on Mars research questions. For example, I'm very happy that 2 members of the Advisory Scientific Committee of the ESRB, Professor Marcus Bonenmeyer, who will speak to you later via video conference from Princeton, and Professor Jean-Charles Trichet from the University of Zurich, have agreed to summarize some of their path-breaking macroprudential research at this very conference. And let me thank very warmly all our guests from outside central banks for their very important contributions. We are convinced that MAS can be a success only if it is a fully collective undertaking. This is manifested inter alia in the fact that after very careful preparations, 2 coordinated cross-border projects have been started in which multiple NCBs and the ECB work together. One uses target 2 payments data to understand better cross-border contagion risks in Europe. The other tries to develop a canonical model for assessing different macroprudential policies, namely a macroeconomic framework in which policy instruments, very different policy instruments, can be tested. As you can see, the ECB and the NCBs of the European Union make a very significant effort to further enhance the analytical basis for the new macroprudential policy branch and fill gaps that have been identified. These efforts are pursued in turbulent waters, as we can see every day. Around all of us, the storm of the debt and banking crisis is there, and whenever a safe harbor seems to have been built around the ships of the open banks and countries, we see more waves from the financial markets that are spilling over the mold or break holes in it. In the middle of it stands, since January this year, as I said, the European Systemic Risk Board, a little bit like a lighthouse warning ships about reefs and other dangers and giving orientations about what should be done to circumvent the greatest dangers. The General Board of the ESRB has physically met 4 times by now in January, March and June, and only a few days ago in September. Our internal procedures are in place and the Advisory Technical Committee is in full operation. Also, the Advisory Scientific Committee has started and agreed on a number of projects. I feel a deeply constructive working atmosphere building up in the ESRB, clearly focused on contributing to the relaxation on the ongoing market tensions and on building the foundations for future stability. Each meeting benefited from an in-depth briefing and wide-ranging discussion on the main risks to the European financial system. On 21st September, we concluded that the risks to the stability of the EU financial system have increased considerably. 3 risks were identified as posing particular dangers from the systemic standpoint. The further adverse feedback effects between sovereign risks, the funding vulnerabilities of the EU banking sector, and the potential or real weakening of growth outlooks both at the global level and at the EU level. And I have to say that due to the high connectedness and nervousness in financial markets, the risks of very significant contagion appear to us as being very elevated. We consider that this situation requires decisive and swift action from all authorities. On the macroeconomic side, the measures agreed upon by heads of state and government of the euro area and EU institutions on the 21st of July this year need to be implemented in the view of the ESRB fully and swiftly. Sustainable fiscal policies need to be combined with growth-enhancing structural measures so that the credibility of sovereign signatures in global markets are restored, preserved and restored when it is the case. Great care needs to be taken also in enhancing the coordination and consistency of policymakers' public communication. On the regulatory side, supervisors should coordinate efforts to strengthen bank capital, including having recourse to backstop facilities, taking also into account the need for transparent and consistent valuation of sovereign exposures. If necessary, this could benefit from the possibility from the European Financial Stability Facility to lend to governments in order to recapitalize banks, including in non-program countries. Even if all these directions are rigorously pursued, European and national authorities still need to be ready to respond swiftly and effectively to unforeseen events, including the wide durations in market valuing sovereign and financial defaults. In our meeting so far, the General Board of the ESRB also discussed a wide range of other issues relevant for identifying, assessing, containing systemic risks for the EU financial system. These include, in particular, the design, role, and execution of stress tests, the range of the macro-prudential policy instruments, including the ESRB's role in the implementation of the counter-cyclical buffers, and the risk of foreign currency lending, complex retail product, such as the exchange rate funds, and high-frequency trading. So this is only to give you an idea of the wide range of meditation that we have in this systemic risk board. Of course, we are in a paradoxical situation in the risk board as well as in the constituency of authorities in general and central banks in particular. We are creating a number of new authorities and entities to prevent the materialization of systemic risk, and we are in the worst crisis since World War II. As you know, I trust that had we not reacted very swiftly and boldly, and I'm speaking of all authorities, in 07, 08, 09, we would probably be in the worst crisis since World War I, and we would have experienced a Great Depression. We are still in the crisis. That's absolutely clear. I would say that we are in the third episode of the crisis, since from our own angle of vision, the first episode starting for us and for central bank in general from August 2007, when we see the start of the turbulences, and I have to say almost overnight in the major money market of the advanced economy, a change in the behavior of the market with spreads and risk premia very sharply and abruptly changing. I said again, practically overnight. For us, it was the 9th of August 2007. And we had in all constituencies in the advanced economy the start of some non-standard measures to cope with this abnormal functioning of markets and taking up the need for ensuring a better transmission of our own monetary policy. It is the way we saw it in August 2007, and it's at that very moment that we started to apply our separation principle, where we put the standard measures, namely the interest rates, as being designed to deliver price stability in the medium run, in line with our definition, and the non-standard measures designed being commensurate with the abnormal functioning of markets. This first episode lasted until the bankruptcy of Lehman Brothers, where we had then a formidable intensification of the crisis of the financial markets, and what I would call the second episode of the crisis, which called for enormously bold responses, as you know. First, because the central banks are always on the front line, but of course immediately afterwards from governments, which had the capacity to cope with this intensification of the crisis. And then we had, at the end of '09, beginning of '10, what we have identified as the start of the crisis of sovereign risk. And we are experiencing this episode where we have a global crisis of sovereign risk, where we are ourselves in Europe the epicenter of this crisis. Exactly like the United States of America were the epicenter of the global crisis of the private signature and the financial sector in general. In both cases, it's a global crisis. In both cases, it has an epicenter. And in both crises or episodes of the crisis, of course, it calls for the highest possible level of lucidity in dealing with it. Also taking into account that there is, of course, an interaction between the sovereign risk crisis and the private risk crisis. Let me only say that since the very beginning of the turbulences, but I would say even, of course, since the very setting up of the euro, we always said ourselves inside the euro system, as speaking under the control of all central banks that are present here, we had said that the authority and the creditworthiness of the public signature was absolutely of the essence, that the Stability and Growth Pact had to be fully respected. You know all that. And we are on record for having said that, even at a time where it was considered too much of a tight jacket by governments, and we are on record to have fought governments on this battlefield. I have to say also by public opinion in general, also by some kind of mainstream of the, I would say, economist appreciation of the situation, and it is absolutely obvious that when the crisis started, the idea that we could count forever on the creditworthiness and the credibility of the sovereign signature was taken for granted. When the crisis started, you might remember that nobody and the market were not putting in doubt for 1 second the creditworthiness of the public signature. When Ireland, for instance, decided to guarantee all its bank, all the capital of the world were rushing in Ireland because that guarantee was considered extremely credible. We could see that at a global level, the credibility of the authorities, the credibility of the signature of the sovereign was put in doubt. We attended and observed downgrading in the US, downgrading in Japan, and a dramatic change in the perception of the creditworthiness of the sovereign. My own understanding is that it is absolutely of the essence. It's not a European problem, it's a global problem, that we restore the credibility and the creditworthiness of the sovereign. It's absolutely essential because it's, in any case, whatever happens, the ultimate backstop, of course. And if you cannot count on the creditworthiness of the sovereign, you are really in a difficult, very difficult world. So we are in the continuity of all our messages and warnings when we are maintaining very, very firmly this position. Now, as you might have seen, there is a certain discretion from the European Systemic Risk Board until now. You have to know that we consider that our most important messages at this stage are confidential. This is explicitly mentioned in the European legislation. So don't be surprised if you don't see us on record too much. We are shipping messages on a confidential basis, and it is what we have been doing since several meetings, particularly since the last one. And I was myself in Brussels yesterday morning to pass on the ministers and the ECOFIN a number of messages coming directly from the ESRB, but I didn't make any remark to the press. I didn't make any press briefing or press conference. we had decided that it was much better to ship these messages on a confidential basis. I thank you very much for your attention. Philippe, your turn.